Good afternoon. Thank you for joining us. Today we're talking about it's official, we're in a recession. What does that have to do with a cute little dog? Well, I'm hoping that if you can take some of the steps and avoid some of the things we talk about today, you can be just as calm as you would feel if you had this cute little guy sitting on your lap and you were petting him and just didn't have a care in the world. So that's our topic today. I'm going to cut him loose while we start. So the powers that be officially announced that we're in a recession as of Monday. Honestly, I can't imagine that comes as a surprise to anybody who hasn't been living under a rock. But it does beg the question of what are things that we should be doing in this time of a recession to protect our financial well-being, mental well-being as it relates to that, and the whole package. We want you to be calm and happy, confident about where you are financially. So the first thing is, even though we're in a recession, this is not a time to make drastic changes to your investments. Hopefully you have a plan in place. You know what you're invested in, why you're invested in each of those components, and how they support your goal. If you don't have that plan, it's a good time to create one. There's opportunities in a recession. We look at that as an opportunity to rebalance in when things are on sale. But there's other kinds of opportunities as well, investment-wise. Being in the market can pay off. Number two, expect emotional ups and downs. We know things are going to feel really good, really bad. And if you read too much news, those swings back and forth will be exaggerated. So do your best not to let the worry and panic take over your life. If you're feeling fearful, there are folks out there that can help you. Mental health folks, financial planning folks, decide what it is that's really getting to you and rope in some resources. But know that the ups and downs that you're feeling emotionally are absolutely to be expected. Related to that, take care of yourself and your loved ones. Recessions can bring changes in jobs, working from home, or even being laid off. And this is a time when falling back on your values and communicating and taking care of the people who matter the most to you is really important. You might have children who are worried by what's going on in the world. This is a chance for you to really help them be strong and be resilient in a time of change. Next, number four, ignore the infotainment that is out there. There's tons of people who are going to tell you they know exactly what's going to happen. There's no way. No one has that crystal ball. Just don't listen to the pundits who act like they know what's going on. They really don't. They aren't experts. They make money if they can get eyeballs on what it is they're sharing. Feel free to tune them out. Number five, stay flexible. No one can tell exactly what a recession is going to bring until it happens. Be prepared to cut back on expenses, understand what the critical expenses are and where you can flex, and know where you can turn for financial backup in case. If you have a recession income plan already, you can potentially avoid the hit of liquidating assets during a downturn. That's what we try and do for clients. And six, my bias, get professional advice. I sort of alluded to that a moment ago, but you don't have to go it alone. The calm opinion of a pro can be the antidote to chaos and the anxiety that come with recessions. This is a time of great change. So that's 6 things you can do while we're in a recession. But I want to share with you 5 things that this is a really bad time to do. So starting with number 1 of the don't do list is don't become a cosigner. Now, being a cosigner on the loan means that you're on the hook for every dollar of that loan. It's not a 50-50 thing. And frequently it's hard to unsign or get off the loan. Normally the person you're helping get the loan would have to refinance without you on it to get off of it. So the risk is much greater during a market downturn for you to become a cosigner. In good times, it's not a situation we recommend, but it can be important. It might be part of your values that you help out a family member with a loan. But during a recession, when the financial risks are higher, becoming a cosigner is not something we recommend. Number 2, taking out an adjustable rate mortgage. Now, you might choose to take out an adjustable rate mortgage because it allows your payments to be lower. And as interest rates change, your payment changes. Well, during a recession, interest rates tend to be at their lowest, so it makes it look very advantageous. But as we grow and come out of the recession, interest rates typically increase, and that's going to increase your payment for your mortgage as those increase. So if you could possibly get a fixed rate loan, that's ideal. But consider worst case scenario. You lose your job and interest rates rise. You're at risk of defaulting on those loans. So if you have a decent credit, a recession may be a good time to lock in a lower fixed rate on a mortgage refinance if you qualify, but be cautious on taking on new debt, which is number 3. Taking on new debt, such as a car loan, home loan, student debt. It's in good times, it can make a lot of sense to have that kind of debt when you have enough money, you're making enough money to cover the monthly payments. But when things go sideways in the economy, risks change and debt becomes a riskier situation. So understand how debt plays into your world and how it may complicate your cash flow in the future if things don't go perfectly smoothly. Worst case, additional debt could lead a family into bankruptcy, the last thing we want to have happen. Number 4, this is not a time to take your job for granted. Yep, it's an economic slowdown. And understand that even big companies come under financial pressure at these times, and they may have to reduce expenses one way or another, and that could mean cutting back on staff. So jobs typically become more vulnerable during recessions, and as an employees, you should make sure you do everything you can to be considered a top-notch worker. No guarantee you'll be safe, but when they make cuts, they're not going to cut their top workers if they can help it. It makes more sense to cut the marginal workers. And number 5, taking risk with investments. This applies to business owners as well as investors. Always think about the future and investing in growing the business. But during the economic slowdown, might not be the best time to make your big risky bets. Early on in a recession, which is where we are now, recessions, by the way, tend to last 12 to 18 months historically. This recession is unlike others, but it isn't different this time. I'm not going to use that phrase, but it'll be different. I just guarantee you. But early on in a recession, it's not a great time to stick your neck out. As we start to see more growth in the economy and we can understand what this post-recession time will look like, that will be the time to consider the growth and the risk. So, for example, taking on a new loan to add physical floor space or increase inventory may sound appealing because interest rates are so low. But if there's a business slowdown, another side effect of the recession, you might not be able to pay the interest and principal on time. So once interest rates start to tick up and we start to see leading economic indicators point up, that would be the time to do it. So we've got 6 great steps to take to protect your personal finances that you can do now, and 5 things that for right now are not a great idea. We want everyone to be healthy, happy, and have lots of confidence in their financial situation because we're here to get personal with your finances. This is Dee Dee Jones at Innovative Financial, live with you Mondays, Wednesdays, and Fridays. We'll see you next time. Thanks for joining us.